As of August 3rd, buying a Miami condo with a normal mortgage stopped being about you. Fannie Mae and Freddie Mac just killed a shortcut that let people buy for years without anybody checking the building's finances. Now, almost every condo loan runs a full background check on the building itself, and more than 1,400 Florida buildings are already flagged as ineligible. In a market like Miami, that one change decides which buildings hold their value and which ones don't. Today, I'm going to show you which buildings are at risk, which ones are safe, and the exact documents to pull before you even make an offer. So for years, condo lending has had a built-in shortcut called a limited review. You put down a decent chunk of money, and the lender could approve your loan by mostly looking at you, your credit, your income, and your down payment. They barely glanced at the building that you were buying into. Well, that shortcut is gone. Since August 3rd, any building with more than 10 units is going to trigger a full review on every conventional condo loan. The lender is going to pull the building's entire financial picture before they'll approve you. They're going to look at its budget, its reserve funds, its insurance policy, how many condo owners are behind on dues, and whether a lawsuit or a failed inspection is sitting in the file. Now, this didn't come out of nowhere. This came out of a joint policy update from Fannie Mae and Freddie Mac from Lender Letter 2026-03. This is just a dense document that landed in March, and it never made it up to the evening news. These two agencies essentially buy most of the home loans in the country, which is what lets banks keep lending in the first place. But when they change the rules, every bank has to fall in line. Miami is going to feel this more than almost anywhere. Fannie Mae's own list of ineligible buildings already runs past 1,400 buildings across the state, and it keeps growing. The qualifications moved off of you and back onto the condo building, and a lot of our buildings are not ready to pass it. So to understand why lenders just suddenly care about the building instead of just you, we have to go back to June 24th, 2021. That's the night that the Champlain Towers South collapsed in Surfside and killed 98 people. Investigators found the building had known structural problems for years, and the board kept putting off the repairs because fixing them meant having to raise everybody else's HOA fees. Florida answered with a law. Any building 3 stories or taller, once it turns 30 years old, now has to get a milestone inspection. A milestone inspection is an engineer physically checking the structure, and it also needs a reserve study. That is a formal accounting of what it costs to maintain the roof, the foundation, and the load-bearing walls for decades. But here's the part that changes the math for owners. Associations used to be able to vote to skip funding their reserves to keep their monthly dues low, but as of January 1st of this year, that option is gone. Full funding is now mandatory. So a building that spent 30 years charging soft dues and starving its reserves now has to catch up all at once, and that catch-up has a name. It shows up as a special assessment, a one-time bill sent to every single owner, and lately those bills have been landing like a gut punch. At the Cricket Club in North Miami, owners got hit with assessments as high as $134,000 per unit. At Mediterranean Village in Aventura, some owners were staring down a $400,000 assessment per unit. And these aren't freak stories on the edges of the market. Analysts tracking Florida condo sales say assessments in the $30,000 to $200,000 range per unit have become normal across older coastal buildings. Picture what a bill like that does to somebody who bought a modest unit expecting a calm retirement by the water. It drains a lifetime of savings, and it can force a sale at the worst possible moment. So if you're planning to move to Miami, make sure that you're subscribed to this channel, because I'm going to keep you current on which buildings are getting hit and which ones are holding steady. Now, the assessment itself isn't even the part that does the most damage to your money. The quieter threat is what that same failed review does to everybody else who owns there, including the people who pay every bill on time. So let me slow this down because it's simple once you see it. If a building's reserves are short or its insurance doesn't measure up, it's going to fail the new federal review and becomes what the industry calls a non-warrantable condo or a non-warrantable project. A regular 30-year mortgage only works if Fannie Mae or Freddie Mac is willing to buy that loan from the bank. If the building fails their review, they won't buy it, so your bank won't offer it to you. What's left is either paying for it in cash or a portfolio loan. The portfolio loan is what the bank keeps on its own books instead of selling. Those portfolio lenders usually want 20 to 30% down, and they're going to charge you 1 to 2 points more in interest. Look at who that knocks out of the buyer pool. First-time home buyers are gone. Anybody planning to put down 5 or 10% is priced out. So what's left is cash investors and a handful of people who are willing to swallow a much more expensive loan. A smaller pool of buyers means that the price has to come down to attract the ones who remain. Now, here's why the damage sticks. Only a few units sell cheap and cash only, and those sales become the comparables that every appraiser leans on to value every other unit in the building. The discount gets baked into the record, and it stays there until the building fixes its finances, which can take years. One label drags down the resale value for every owner inside, whether or not they even miss a single payment. So here's where all of this leaves Miami today. Look at the data, and it's plainly a buyer's market. We're sitting near 14 months of condo inventory right now, when a healthy market usually runs about 6 months. Across South Florida, more than 90% of condo sales are closing below their original asking price. Insurance is part of the squeeze too. The average individual condo policy in Miami runs about $2,507 a year, while the national average sits closer to $455. That gap is a big reason why our monthly carrying costs feel so much heavier than almost anywhere else in the country. Now, there's one piece of good news here that's all buried in. Citizens Property Insurance, that's our state's insurer of last resort, cut its rates on July 1st, about 8.8% on multi-peril policies, and it cut 5.5% on wind-only coverage. Private insurers have also been coming back into Florida since 2022 reforms, and that relief is real, but it's showing up on the insurance side while the reserve and the financing side keeps tightening. For plenty of buildings, it's nowhere near enough to cancel out the pressure. So here's what it means for you if you're looking at a condo. If you're buying, make sure that you ask for the HOA questionnaire, the reserve study, and the delinquency report before you make an offer, not after you're already under contract and it's a fight to walk away. Then learn the one distinction that separates a deal from a trap. A building can be cheap right now simply because the whole market is soft, while it's still healthy underneath. It has funded reserves, almost nobody behind on payments. That building tends to recover. If that building is near water, it is definitely a good buy because in the future, once all the work is done, it's going to go up in price. A building that is cheap because it's failing the actual financial checks is a completely different animal, and its price is going to keep sliding downwards for years until the money problem gets fixed. So if you already own or you serve on your board, get your reserve study updated and your books in order now. Underwriters are going to comb through years of statements, meeting minutes, and all of that information before they're going to approve a building. Disorganized buildings are already watching their closing stretch from 30 days to 45 days or 60 days and then landing with a denial. So this isn't a temporary policy that's going to fade away in a couple years. The Fannie Mae rule change is permanent. Every condo buyer in Miami is going to go through this exact same process from here on out, and lenders will keep punishing the buildings that hid the bill for decades. I want you to check out my next video, Never Buy These Types of Homes in Miami, where I'm going to walk you through the specific types of properties that look like deals on paper, but they're going to cost buyers for years, and the warning signs that most people miss until it's too late. So make sure that you subscribe so you never miss a breakdown like this one. And while you're there, head to the show description below and sign up for the free home bot. It tracks your Miami property's value month over month, so you always know where you stand before you even think about selling. And if you're thinking about making a move, buying, selling, or just figuring out your options, my team and I would love to be your real estate resource of choice. You can send me an email, joe@joesellsmiami.com, and we can talk about your situation. Thanks so much for watching, and I'll see you in the next video.